Howdy, partners. I don't spend much time trying to predict interest rates or what the Fed's going to do or the economy, but sometimes there's big trends that are worth paying attention to. And the biggest one over the past few years has been inflation. So today we're going to take a look at that and why REITs may be one of the best opportunities in the market right now, not just for dividend investors like us, but overall. So, this is the yearly change in the US Consumer Price Index over the past 20 years. And the COVID spike is really obvious. But if you look, the inflation levels have not returned to pre 2020 levels. And I'll show you Europe's chart. This looks almost identical, the big spike, and then things are not back down to where they were before the pandemic. And you can think of these charts as showing how fast the prices you pay as a consumer are rising. But there's another angle that we can look at, and that's the producer price index. So this is how much businesses pay for the goods and services that then they go on to sell you. So if CPI is what you pay at the checkout counter, PPI is what the store is paying their distributors. So here's the PPI year over year change for the past 20 years. And if you look, you can notice a difference. So consumer prices have flattened since the pandemic, but producer prices are still rising. And in the most recent report from July 24 to July 25, PPI rose 3.3%. It was expected to be 2.5%. And from June of 2025 to July, PPI rose 0.9%, almost 1%. So if we break it down further, we can see that the cost of services, which dominate the US economy, are actually rising faster than goods. And the biggest driver of these increasing services costs is increasing wages. We can look at the Atlanta Fed's wage tracker, and it's going to show us the same pattern. So it's a big spike in 2022, and then it's slowing, but it's still above the pre-COVID baseline. And wages have been outpacing inflation since early 2023. So in theory, there's going to be a relationship between rising wages and rising prices. When wages go up, businesses might raise prices to cover those higher costs, which can cause inflation. And then the other end of it is that the people who work there have more money to spend, so that can push demand and prices up. But this isn't guaranteed. If workers become more productive, it doesn't necessarily lead to inflation. And if the economy's slowing, central banks may tighten policy by raising rates or decreasing money supply. Or if companies and consumers expect prices to be stable, those higher wages don't always lead to inflation. It all depends on the overall economic situation. So recently there was a meeting at Jackson Hole where Fed Chair Jerome Powell hinted at a shift. And that's on focusing more on supporting employment and less on forcing inflation back down to 2%. The most recent job numbers that came out reinforce this. This is probably what's going to happen. So given the fact that consumer inflation is still running higher than it did before 2020, producer prices are continuing to rise, and so are wages. We could be entering a new era where inflation runs closer to 3% or higher. So if inflation is going to be higher, the question is, do we need to make changes to our portfolio? And the good news is that when you focus on buying strong cash flowing companies at reasonable prices like we do, the answer is no. But it is probably worth asking what kind of assets do well in inflationary environments. Stocks generally keep pace with inflation over time. Inflation protected bonds like TIPS in the US adjust their principal with inflation, and physical assets like gold, commodities, and real estate often shine when inflation is sticky. Real estate is a great inflation hedge. First, the supply is naturally limited, so the value of properties tends to go up with inflation, and so do the cash flows that are generated by that real estate. So as prices rise, landlords can raise rents. One of the easiest ways to own real estate is through REITs. A REIT's a company that owns and manages a group of real estate properties that make money, like apartment buildings, offices, shopping centers, that kind of thing. And I think they're especially interesting right now because they've been beaten down by rising interest rates and they're trading at a steep discount relative to the broader market. You can see this is at one of the lowest levels it's been going back to like 2004. And with valuations this depressed, REITs are also offering unusually high yields today, which gives us the chance to lock in elevated income streams before the market wakes up. And just to show you this, here's a couple well-known ones. We can look at their yields and see that they're higher than typical. So here's Prologis. They own warehouses. And we can look at American Tower Corporation that owns cell phone towers, wireless communication towers. And so, if Powell is signaling that inflation isn't going back to the old 2% world, this might be a great opportunity to pick up some of these assets that not only survive inflation, but pay you more because of it. And if this is interesting to you and you want to see some of my favorite REITs, some that I think are particularly interesting right now, there is a download in the description to this video. Go ahead and click on it, get those interesting REITs, and check them out. Thanks for watching. We'll see you in the next one.